Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Tuesday, January 9th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be with you for the next 30 minutes or so as we try to figure out what's going on in the market. Had a nice bounce back day yesterday, which we'll get into here in just a couple minutes. I do want to give a shout out to all of our members at EarningsBeats. Had an absolutely fantastic crowd on Saturday for our Market Vision 2024 event. I unveiled a few secrets I thought about 2024, and we'll see. I'll stick to some of those, but I do want to thank everybody that was able to make it out. I also want to give a big shout out to Grayson Rose at Stock Charts, who joined us on Saturday. Grayson's not only a great friend, he's a great technician. He is the Director of Operations at StockCharts.com. And because all of us here at EarningsBeats and all of our members rely so heavily on the Stock Charts platform, it was really great to have a kind of a personalized presentation from Grayson talking about the new Sharp Charts platform. And some of the things that we can look forward to, how we can better maybe some of our trading or the way we set things up, maybe just become a better trader because of being more prepared using many of the tools and features that Stock Charts offers. So that was really a great thing having Grayson join me. I always like to get together with Grayson and all the really good folks over at StockCharts.com. So again, thanks, Grayson. As we look forward to today, we're into the second week now of 2024. First week wasn't so good. Yesterday we got off to a much better start. Again, I'll go over those numbers in just a minute. However, we do have red futures this morning. We've got the Dow Jones futures down 181 points, which is about 0.5%. They took a little bit of a hit early yesterday because of Boeing. The MAX planes were grounded again. Just, one of those lingering things from the last couple of years on Boeing. But anyway, Boeing took a big hit at the open yesterday. That certainly had an impact on the Dow. But everything seemed to go pretty well yesterday. But now the Dow futures down. S&P 500 futures down 26, which is about 0.5%. NASDAQ futures down about 135, which is about 0.8%. And if there was one thing that was clear last week, and maybe even into the end of 2023, it was the rotation that we were seeing away from growth and into value, into areas that really hadn't performed as well. And yesterday, it kind of went back to the way we were used to. We got a little bit more performance from those big NASDAQ stocks, not as much from some of the more value-oriented defensive areas. Small caps did okay, but certainly didn't keep up with the NASDAQ. And so, which way are we going here in 2024? I think that's kind of what I'm looking at. I do think that there's something to this rotation away from the large cap names. I mean, when you talk about semiconductors going up 95% last year, that's where, sometimes reading the charts needs to take a back seat to just perspective. And just to understand how difficult it is for a large group like semiconductors to go up 95% one year and then just continue it the next year. I mean, you reach a point, these companies aren't growing. Their values should not be growing by 100% collectively. I mean, we're not even just talking about one company. Maybe NVIDIA deserves it. I don't know. But to have the whole group go up 95%, of course, NVIDIA is a big part of that, but it's just a lot. So it would be okay if some of these areas that led in 2023, and really some of the areas that led even into the second half of 2022, it would be okay if they took a little bit of a back seat in 2024 and let some other areas catch up. That's kind of what I'm expecting. Maybe a little bit in 2024. Maybe that's the part that's a little different than 2023. But obviously, we got a lot of stock market left this year to see what happens. But that's one theme that I'll certainly keep a very close eye on, what really is taking place there. All right, let's go ahead and take a look at the action from yesterday. And you'll see I just gave you a really quick, tried to make this larger so everyone can see it, but I guess I can make it even a little bit bigger there. If you take a look at the Dow Jones Industrial Average, you see it was up a little over 0.5%, which isn't bad considering that it was down in the morning. And like I said, carried lower at the opening bell by Boeing, primarily by Boeing, but there were some other components as well that didn't hold up in the open. Things started to pick up later in the day, and I think those technology names, Apple, Microsoft had big days, certainly swayed the Dow much more to the upside throughout the day. S&P 500, though, you can see up 1.4%, gaining 66 points back to 4763. Not too far from getting back into the 4800s and, getting close to that all-time high, which I believe is 4819 and change, or maybe it was 4818 and change. We're not that far away. So yesterday's big gain in the S&P got us right back up there again, but now the future is looking to take us back down a little bit. NASDAQ, though, up 320 points yesterday, which was 2.2%. That was a really big move, and the NASDAQ hadn't performed very well to start 2024. It didn't end 2023 on a great note. So it was nice to see that bounce back, but now looking at futures, you got to wonder, okay, was it just a one-day wonder? Are we going to see a little bit more selling in the NASDAQ to open the year? I can't tell you that, but we're going to find out together here over the next couple days to few weeks. And January, one of the sessions that we had leading up to Market Vision 2024 was the January effect. And if you're not familiar with that, we'll probably have offers coming out for you to look at, check out the recording if you weren't at our Market Vision 2024 event, or you didn't see the couple of events that we had leading up to Market Vision 2024. Those will be available to everyone at some point down the road. Probably be maybe try our service or something and get the recording for free. Whatever it is, check it out. It's really amazing, honestly. First time I saw the relationship between January trading and the balance of the year, I was just like scratching my head, like, no way, it can't be this easy. But I think there's a lot of validity to what happens to the stock market in January and how good or how bad January is. I think that gives us some clues for the balance of the year. So just another reason maybe to watch the market pretty closely here over the next few weeks. Small caps, you can see small caps, mid caps, both up more than 1%. Nice day. Didn't do as well as the NASDAQ, but that's okay. Every day is going to be a little bit different, but it was nice to see strong action on both small and mid caps. And then down at the bottom here, check out the VIX. VIX moving back down, perhaps trying to get back down below that 13 level. I would imagine we'll see that jump this morning with futures down. But watch the VIX, because there are, maybe I'll show you that chart. I've done an article on the VIX. I did it, I don't know, maybe a month ago, where I laid out why I thought, it was very, very unlikely that we were going to take a big hit in the market. Maybe I'll try to revisit that if I remember here toward the end of the show. But anyway, the VIX being down in low 13s is very bullish for U.S. equities historically. And so let's keep an eye on the volatility index, because if the bears truly want to gain control of the action, we're going to need to see that VIX jump by about 50%. I think the VIX going to 20 would obviously accompany probably some sort of a drop in the market. But if you really are bearish and you really think we're going to have a bad year, you've got to get that VIX over 20. That's where the bad stuff happens, with a VIX above 20. So anyway, let's keep moving, and maybe I'll have some time to come back to that subject, the VIX, a little bit later in the show. S&P 500, you can see here the bounce off of that 20-day moving average. Beautiful bounce. That's a really nice candle. Now, if we were to fail, go right back down below the 20, obviously in the short term, that would be a little bit more bearish. That could get a lot of the bears getting more excited about maybe their possibilities in 2024. I can tell you I'm not bearish going into 2024, but I'm also not as bullish as I was going into 2023. And those of you at the Market Vision 2024 event on Saturday, I think you know a little bit more about what I'm talking about there. But there are definitely some signs, and we'll be talking about them throughout the year, but there are some signs that suggest this is not going to be a repeat of 2023. And I'll just leave it at there for now. The NASDAQ 100 got back up above its 20. So it went below, but it held on to the prior price high. So this price high just above 16,000, we broke that, never looked back in December. I mean, never even went back and tested that level until the last couple of days. So, or yesterday, not so much, but last week, last Thursday and Friday, you can see came down, didn't quite get to that prior high, but we got pretty close from our high up near 17,000, dropped, probably about 4 or 5%. So we had a nice little pullback, got back down close to that breakout, and then turned up. So now I'm looking at this as support on the NASDAQ, probably around the 16,150 area, and your resistance up near 17,000. And yesterday's recovery back to 16,650 kind of gets us back in the middle of that range. So today's action futures, while they're down, still going to keep us, unless things really deteriorate in the next 20 minutes, certainly going to keep us in this trading range. And that's what I would watch here in the early part of January. The Russell 2000, really nice move up off of gap support. So 192.67, that was the close back on December 13th. We opened above that, opened up around 196 or so. And then on this way down here over the last week, the selling that we've seen, I wanted to point out a couple things. Number one, of the $12, excuse me, of the $12 that we dropped in the IWM, I think over 50% or maybe right around 50% of it were these gap downs. So you can see we gapped down, I believe, 6 consecutive days on the Russell 2000. And if you add up what we were down at the opening bell of these last 6 days, it's roughly half of the entire drop. And if you listen to me back in 2022, when the market was bottoming, one of the things I was talking about was that the final drop that we had in June of 2022, well, before we went a little bit below in October, but the majority of the losses in 2022 were in the first 6 months. And from May to June, what I like to call market maker manipulation was rather apparent. Almost all the losses that we saw on that last move down in June had to do with the opening bell. It was the selling at the opening bell and then in the first half hour or even 60 minutes of trading, which I like to call amateur hour, because market makers fuel the selling to kind of get the momentum started to the downside. And then the traders start jumping in because they're starting to lose money. And so they can't take it. They want to make sure that they preserve their capital. They sell in the morning. And then we see folks come back in and buy later in the afternoon. Now, the latter part, buying in the afternoon, really wasn't present here, as you could see the last several days. But yesterday it was. And we got a little hint on Friday. When we gapped down, we had a nice rally in the morning, back up, and then we came back down one final time in the afternoon. Yesterday, the action stuck. So we went back down, we put in a double bottom from Friday's low, and then we came rallying back, and we got a nice push back to the upside in the IWM. So getting back above both the 20-day moving average, which right now is sitting just below 195 at 194.90, getting back above that. And then also there was this area of support. We still haven't gotten all the way up there. 197, 198, 198.50. That was like the triple top that we had throughout 2023. Never could really get through that yesterday, but it was a big rally. Now, if I'm going to offer any cautiousness, I would say the rally was on pretty light volume as opposed to the volume we saw on the way down. So I guess on the one hand, the futures this morning, not really. I'm not shocked. I do think that we're probably going to have choppiness in this first quarter of 2024. That's kind of what I'm thinking. I think we could hit the 5,000 level to the upside, but I also think the S&P could drop into that 4,500, 4,550 area. We finished 4,760 something yesterday. So I just think there's going to be some chop leading into this year, mostly because we had such a big rally. I mean, you got to keep things in mind. We had one of the biggest rallies. I think with the selling the last week or so, we're no longer showing the biggest gain from October 28th to January 18th. That's the most bullish period of the year. We were getting close to having, going back to 1950, the best October 28th to January 18th period. And then this pullback kind of put a little damper on it, but we still got another little over a week to go before this bullish period ends. So there's still an outside shot that this is going to be the best period that we've ever seen from October 28th to January 18th. And that's saying something because this is the most bullish period of the year. So to have the most bullish, 2023 into early 2024 turns out to be our most bullish. That's really saying something, and also makes me think, okay, I got to keep things in perspective. I mean, that was a massive rally. I don't think too many folks saw it at the end of October. And I'll be quite honest. I mean, things weren't looking great at the end of October. The only thing I said that looked really bullish was the fact that we were going to flip the switch from the most bearish historical period, which is October 22nd to the 27th, flip that switch to the most bullish period, which was October 28th to November 6th. And you can see what happened. There's October 28th to November 6th. I mean, I don't make this stuff up. I post it year after year. And we did exactly what we were expecting that was going to happen, at least based on history. And then once that happened, pulled back, and then we made a blast off. Of course, it's the IWM, but we saw it across the board in all of our major indices. And when I'm talking about the best October 28th to January 18th period, I'm talking about the S&P 500, dating back to 1950. So you're talking about 74 years of strong end-of-year periods, and we're still possibly going to print the number one period of the last 74 years. Folks, it's okay if we pull back for a little bit. Keep some perspective. What else? Let's take a quick look at the transports. So transports fell, lost their gap support, lost the 20-day moving average, came back up and tested it from underneath. But with the market looking the way it is, probably going to see a little bit more selling, I would think, today. I guess my question is, do we hold the recent low? Do we just go back, maybe have a double bottom or near that 15.4 level? Or do we go all the way back maybe to this where we broke out of this bottoming head and shoulder pattern? Left shoulder, neckline, head, neckline, right shoulder, blast off. That breakout came at 15.2. Look at the 50-day moving average. It's rising from underneath at 15.112, 15,112. So we've got short-term support 15.4. I think pretty key neckline support at 15.2, and then a rising 50-day that's now above 15.1 and rising, getting closer to that 15.2 level. So you got a lot of support to watch here on the transports. If that all were to break down, then I think, because transports, give us a little indication of economic activity ahead. So it was great seeing that fourth quarter run, but to see it roll back over and to start losing some key support levels would be maybe something that wasn't so bullish, and would certainly be, if you were, keeping a slate of bullish signs and bearish signs, you'd have to throw transportation into that bearish category if we were to lose these key support levels. So this will be a group that I'll be watching pretty closely in the near term, especially today. If they could outperform today with the market pulling back, that would be a good thing. We'll see how this plays out. But transports, normally the relationship here is that transports have a tremendously positive correlation with the S&P 500. So it's never good to see transports roll over. I mean, look what happened in July when the transports rolled over. We had a correction on the S&P 500. The S&P 500 doesn't, if you think about it, they both kind of feed off the same things. The S&P 500 feeds off a stronger or what we're expecting to be a strengthening economy. That's the only thing that really matters to transportation stocks. They deliver goods. So the way their prices are going to go up is by either the economy strengthening so that there's more delivery of goods, or the market anticipating the strengthening of the economy. So it's always important to follow the transports. But if you really want to get something that tracks the S&P 500 pretty closely, this is the group. So if you're bullish, you want to see the uptrend off of the October low continue. If you're bearish, you really want to see this roll over and lose a lot of the key support levels I was just talking about. Let's keep moving. Earnings beats. If you are unfamiliar with earnings beats, let's say this is your first time. First of all, welcome. Certainly appreciate everybody watching the show. Be sure to like our video, our show, and also make sure you subscribe to our channel. You can see that Tyler just pulling it up on the screen, show you how to do it. It's very simple. And even if you can't become a subscriber, you'd like to, but you can't. Maybe it's for financial reasons. Maybe you don't have time really for the market right now. Whatever it is, hey, that's okay. You can help us in other ways. Click the like on our video and subscribe to our channel. That helps us. Really have a goal in 2024. Earnings Beats as a team has a goal to really develop this relationship and grow our community online and through YouTube. So that's one way you can certainly help us. All right, chart of the day. Well, I got a couple I guess I could look at, but I'm going to go ahead and pull up Boeing because Boeing did have a big hit yesterday. So what is going on with Boeing and what should we expect as we go forward? Well, I mean, again, perspective, this was not going to last forever. Boeing was one of the most heavily accumulated stocks, in my opinion, over the last 2 months, maybe, well, probably from the end of October toward the end of December. So roughly 2 months. And I say that not because I have any idea what's going on Wall Street. I mean, I have some idea, but I can just look at the charts. Do you see? I mean, once we broke out of this bottoming head and shoulder pattern, do you see any red filled candles? I mean, a red filled candle where you have a candlestick that's filled in red instead of hollow. A red filled candle means you close below the open. All that it only takes having a bad day here or there. I mean, we've seen it so far at the beginning of 2024, right? There's some red filled candles. We went 2 months, and I honestly, outside of this one on November 6th, there's really nothing, none. So I would argue that Boeing was one of the strongest stocks, even if it didn't maybe have the highest percentage gain, probably had a pretty good one though. Still, I would say it was one of the best performing stocks because of the nature of the chart. Not the fact that it went up. A lot of stocks went up, but I'm seeing a lot of hollow candles. I mean, look at this stretch right here in the first couple of weeks of December. I mean, almost every day closing on the high with a hollow candle. This isn't gap ups. This is buying, at the opening, running the rest of the day, gapping down, running the rest of the day, gapping flat, going up into the close, moving up into the close. Most of these days, we were not gapping higher. In fact, several of them, we gapped lower, and it was even more of a move to the upside. So let's approach Boeing with that knowledge first, because I think it's really important. The second thing I would do when you have a straight up move like that, I would be looking at Fibonacci. I don't use it a lot, but when I get a straight move up like this, I think it's something to at least consider. So if we connect the bottom and then connect the top, I would be looking first at the 38.2 retracement level, which was at 234, 233-ish. And then the next one, the 50%. That's usually the two that I look for on a really strong stock. A really strong stock doesn't normally go down to this one. That's still a key Fibonacci level. But when I get a stock that's this strong, I mean, why would you go all the way back down and lose more than 60% of the gains if there's that much accumulation? So I would be looking in this range, and that's right where we gapped down to yesterday on Boeing. So keep that in mind, that I think we're down near that range of support. I wouldn't be shocked to see us move right back up from where we are right now on Boeing. But if it does keep moving down, I would just maybe consider that 50% threshold, 50% Fibonacci retracement, which is down around 222. So maybe we see another $7 to the downside, but watch for a reversing candle. If we do start off the day lower with futures down, let's see if we get some kind of reversal off of 222 and get back up above that 50. That would be the signal, or one of the signals for me on Boeing. Now, the other thing that you could look at on Boeing Boeing has been pretty weak for a long time throughout the pandemic. We had a huge drop at the very beginning, came back up, initial rally, and then kind of went sideways. We didn't go below that March pandemic low, but we did put in a double bottom in 2022 during the cyclical bear market and made this rally back up, broke above this high. That was from 120 to about 170. That gives us another $50 of upside to the 220 area. Notice that's almost exactly where we ran, and we struggled before breaking out, pulling back one final time. And then there's on a weekly chart, you can see those hollow candles pretty strongly. If Boeing is one thing, though, as you look at this chart, it's volatile. It's like, okay, it looks like it can't be saved. It's going to, maybe tumble back to those March 2020 lows. Next thing you know, we got a rally. We're through the 20-week moving average, probably putting in a bottom, right? Nope. Month and a half to 2 months later, right back down at that bottom again. And then looks like, okay, probably going to break through, right? Overall, it's not been a very good chart. And then we just break out, gain from 120 to 220, $100, almost 100% in 3 months. And then all of a sudden volatility is gone. Then it picks back up again as we go down. My point is, it's hard to trust a lot of what's going on in Boeing, but I do believe that the worst is behind it. If during the cyclical bear market, we can't get back down to that pandemic low, I think that's telling us that the low is in place for Boeing. And so I believe we're going to rally back off of this weakness that we're currently in. I wouldn't be surprised if we were to break back out sometime in this first quarter. I might be asking a lot, but I do think Boeing is going to have a better year in 2024. To the downside, I would be shocked if we go down, put in a bottom here. I think between the moving averages and that Fibonacci 50% level, moving averages, these weekly moving averages coming in between about 215 and 230. And then we had 222 as our 50% Fibonacci level to the downside. I think that's a pretty good area to find a bottom in Boeing. All right. Next thing and the last thing I want to talk about before we wrap up the show is one of the things I talked about in Market Vision 2024. And I just don't understand why folks in the gold camp are so bullish. Okay, yeah, we 52-week high, all-time high recently. I get that. But if you look at the things that really drives gold, I don't think you're going to get tailwinds in 2024. I think you're going to get headwinds. So my feeling is gold may go up, but I do not believe it will outperform the S&P 500. So let's talk about why. As I do my research, I just try to look for relationships, to help me or to help guide me in various areas of the market. And one thing I discovered years ago with gold is that, I've known for a long time that the dollar, if the dollar goes up, that's a headwind for gold. If the dollar goes down, that's a tailwind for gold. Well, what drives the dollar? And this chart is this is kind of like my go-to of what drives this chart, or what drives gold, I should say. When the 10-year treasury yield, if we go back like in the 1980s, think about economics and think about the dollar and what would drive the dollar higher. Essentially back then, before we became more of a global economy, back in the 80s when I was studying, economics, we always talked about higher U.S. rates. If rates went up, the dollar would go up. If rates went down, the dollar would go down. Because usually if the economy is weakening or we think it's going to weaken, you start seeing the rate cuts. And if the market's heating up, if our economy's stronger, then you start seeing the rate hikes and so forth. But think about it, if our economy's stronger, that should help our currency. And if our economy's weaker, that should hurt our currency, right? So the stronger economy helps our economy. I gotta start over again. Maybe I need a drink of my latte here. All right, let's start afresh here. So when the economy strengthens, that should help our currency. When the economy weakens, it should hurt our currency. Okay. So now that we've become a global economy, it's really how strong we are relative to how strong other foreign economies are. So it's not us against ourselves, it's us against the world. And one of the strongest areas of positive correlation when we look at other countries, what I've found is that the US and Germany are literally, they're like that. I mean, they tend to go together in the stock market. They tend to go together in the bond market. They just tend to go together. And so I thought, okay, well, which economy is stronger? Well, how do you tell? Well, rates. I mean, your rates generally are going to go up normally because of the economy. Sometimes it can be inflation, which kind of throws a little monkey wrench into this because that I think is what we've been dealing with lately. But currently, and you can see back from 2012 to 2018, the US 10-year Treasury yield minus the 10-year German Treasury yield was going up. And not too surprisingly, so was the dollar. And then we ran into some struggles and we've kind of been going back and forth. And that's kind of what the 10-year Treasury yield has been doing. And we're starting to see a little bit more inverse of a relationship. You can see down at the bottom of this chart, I have correlation, and you can see how often we're seeing this correlation. I think part of it has to do with the pandemic and the fact that we had inflation. So it's a little bit more difficult to look at the yields between the two countries and talk only about the fact that it's the economy, because it's actually about, more the 10-year Treasury yield in the US has been going up more about inflation than because of a huge strengthening economy. Our economy's been positive, but it hasn't been outrageously strong. Rates going up have been the fear in the bond market that inflation could take a hold. And anytime you've got that, you're going to sell bonds and send yields higher because nobody wants to hold a bond when, inflation is going up, because you've got a fixed rate to maturity. And when it was at 3%, if you have 6% inflation, you're losing 3% on your money, right? So anyway, I think things are a little cloudy right now, but in the long term, as things stabilize more and more and further we get out, one of the things to watch is the yield in the US versus Germany, because generally we have a very positive correlation. These circles are, we've seen maybe 5, 6, 7 times over the last 15 years where they've gone negative. And usually when they do go negative, the dollar is the one that plays catch up. So the dollar plays catch up to whatever the yield's telling us. This right here, inverse relationship right there, dollar played catch up to the 10-year Treasury yield. Here, dollar plays catch up. Dollar plays catch up to the upside. All those were to the upside. Here, dollar comes down to the downside to track what was going on with the Treasury yield. Here, dollar goes back up, and then here, dollar comes down. Now we're getting this divergence, and the Treasury yield in the US versus Germany staying relatively flat, but we've been seeing this drop in the dollar. I think those who are calling for further drop in the dollar, I think you're going to be mistaken. I think once we get through this period, I believe the dollar is going to make that move to the upside. And the thing is, the dollar is what drives gold, or one of the things that drives gold. The other thing is high volatility. I mean, if you got two things, if you asked me the two biggest things that drive gold and their performance versus the S&P 500, I'm going to tell you it's based on the dollar and it's based on our volatility index. If volatility is low and the dollar goes up, I wish you the best of luck with gold. It ain't going to outperform. That's historically the way it works. So let's see. I wanted to pull up. I'm going to wrap this up. I know I'm a few minutes over here. So here's the dollar. Look at the dollar from 2002, early 2000s to about 2011. Right there. There's your dollar going down. Gold's going up, and gold relative. Well, here's gold going up. Here's gold relative to the S&P 500. When people talk about gold, first thing that comes to my mind is, will gold outperform the S&P 500? Because if it won't, or I don't believe it will, then why am I investing in gold? To hedge? Okay, well, look at what this hedge has done for you for the last 12 years. All you're doing is giving away return in your portfolio. I don't believe in hedging with gold when the S&P 500 is outperforming gold. What I really want to do is hedging gold when gold is outperforming the S&P 500. That was back during the secular bear market. Because why? Well, volatility. I mean, look at these VIX spikes. Look at when gold outperforms the S&P 500. I've circled it to make it easy. Big spike, big spike, big spike. Even here, 2020, big spike. I want you to look at the VIX and tell me what happened with the VIX. The VIX, big spike, big spike, big spike, big spike. You need a spiking volatility index to outperform. Everybody talking about the price of gold, and yeah, we just set an all-time high. Okay, yeah, let's get the pom-poms out. Look what it's doing relative to the S&P 500. I mean, cheer on all you want, but literally in the fourth quarter, while we were making a breakout to an all-time high, gold looks great. It underperformed the S&P 500. The S&P was doing better than gold. So let me just ask all of you gold bulls, what's it going to take for gold to outperform the S&P 500? If gold goes up 10% in 2024, which it's possible, I can see it happening. What if S&P 500 goes up 11%? Which would you rather be in? That's all I'm saying. Wait for gold to start outperforming. I have been listening to gold bulls for a dozen years now talk about getting into gold and how gold is so great. Gold's been horrible. Next time somebody tells you gold's at an all-time high, ask them, well, what's it doing relative to the S&P 500? If I have my choice between two investments, tell me the reason why I should buy gold versus the S&P 500. Because most folks that talk about gold don't talk about that. They talk about, oh, all-time high, big breakout, bullish pattern. The cup right here is longer than the uptrend almost. I see a cup and a cup, maybe a little bit of a handle. That is a really lengthy pattern. I wish the best for all the gold bulls out there, but I just don't see it. I'll stick with the S&P and stick with U.S. equities, and I'll let others deal with gold. Now, you give me some reasons like a falling dollar that actually breaks key support, and you start seeing, that's what drives energy and materials on a relative basis, falling dollar. So show me the falling dollar when it happens and show me the reasons why it's going to continue to fall. And then I'll be right there with you with gold. Until then, no way. Anyway, that's it for me. Let's take a quick look at the action. What's happening here in the early going. Dow Jones down 224.6. S&P down 0.5%. NASDAQ down 0.6. So it's kind of evened out here in the early action. It first looked like the NASDAQ was going to take the big hit. Small caps actually are taking a big hit along with mid caps. That's where your laggards are at the open today. I saw something similar though yesterday, and then the small caps came back. So it'll be interesting to see how that plays out again today. And for the small caps, the IWM, I would just continue to watch that 192.67 level. That's your key gap support that's been holding the last couple of days. So if we take off to the downside, that would be something that would get my attention there. But otherwise, we're just starting the year off choppy, which I'm not shocked. I think we probably should expect a little bit more of this as well. Anyhow, that's it for me. Listen, everybody have a great rest of your day. Again, Happy New Year to those I didn't see last week. Thank you so much again to all of our members at EarningsBeats for coming out and supporting us for Market Vision 2024, which was Saturday. I actually spoke. My forecast was about 3 hours long, or might have been 2.5, 3 hours. I don't think it was 3.5, was it? No, I think with question and answer, I think maybe it went on about just a little over 3 hours. But those of you who know me I don't leave anything on the table. I wanted to explain my thoughts about 2024, and amazing. Well, maybe not so amazingly, almost every one of our members stuck till the very end. Even though I talked about it being an 1.5-hour segment, we went probably close to 3 hours, or maybe just a tad over 3 hours with Q&A, and we had almost everyone still watching at the very end. So clearly you were interested in some of the things I had to say. We'll see how things pan out in 2024. Anyway, have a great day, everybody. Happy trading.